So, welcome to the seminar. We are speaking today about cryptocurrencies and crypto investments, if they should be part of modern portfolio diversification, if it makes sense to have also a part from your all-over investments hold in crypto or not. I welcome here a speaker, Amandeep, and David Doss and Dr. Oliver Krause. Please, everyone, can you introduce yourself? Let's start with Aman.
Hi, my name is Amandeep. I'm based in Copenhagen. I have been in a cryptocurrency interest since 2016. Not very long ago, I will say that, but sufficiently long. And I have been investing in different projects and as well as kind of watching the Web3 space, currently mentoring with Outlier Ventures and few Web3 startups. So that's me. David, maybe.
Hi, everyone. I'm David Doss, and I'm the founder of CKC.Fund, which is a digital asset and cryptocurrency fund offshore in Cayman Islands. And I have been spending around the last 6 or 7 years on blockchain and cryptocurrency, including blockchain projects at Citibank, Gemini, and a wide range of other organizations.
So my turn, I think. I'm Oliver Krause, based in Berlin. I am the initiator and co-founder of Entitled Inc., think tank and venture studio or venture network, as I would call it, in the Web3 blockchain space, and started that back in 2017 with a number of early crypto guys and guys like myself who have more background like in strategy consulting and VC. And since then, I have been investing in the space. I have been also building some ventures there. And recently, actually, I'm also a limited partner at an exclusively token VC fund. It's Made Capital.
Thank you. I'm the moderator today. My name is Carl Seelig. I am the CEO from ChainBLX. We are a company which provides virtual hedge funds in the Cayman Island, meaning we overtake all the management and the legal compliance for the hedge funds which we provide to our clients. We offer from VC funds to crypto funds, and I'm also the curator for Digital Davos. Thank you very much. Thank you very much for everyone to listen. Thank you very much to our panelists for taking the time. Let's start with the first question. We will have audience which probably want to understand better what is even a cryptocurrency. And can we start with describing how a cryptocurrency functions and what it is? Because everyone hears it, they hear about mining, they hear about nodes, they hear about consensus, algorithms and Merkle trees and decentralization. But just in the first 5 minutes, I would like to give them an overview, because when we go deeper and if it should be part of the diversification, it becomes also that we have to define what is really the intrinsic value of the cryptocurrency, what is the underlying value. And this will heavily impact the risk and everything. So a little bit understanding is necessary to lay the groundwork. And I just asked in the group who wants to start, and let's start with transaction verification, consensus, and security and mining. Who wants to overtake this question?
I mean, I would rather actually, Carl, if I might suggest to rather than going into the technicalities, I would rather start with the idea of Bitcoin and Bitcoin blockchain and how this came to life and what the special thing is there, if I may. So Bitcoin actually, which came to life in 2009, was the first digital bearer token that could be transferred peer-to-peer across the internet. And that is a pretty big thing because previously it was not possible to transfer value across the internet without third parties basically verifying transactions like between two banks, for instance. And this has been done and is done today with the Bitcoin blockchain. And the Bitcoin blockchain basically is a decentralized network of computers, so-called nodes. And they store an identical copy of a ledger that basically describes the state of ownership for assets, in this case, the Bitcoin assets, at each point in time, and describes also changes in the state of ownerships. Yeah. So, and this is achieved through a so-called consensus mechanism. In case of Bitcoin, it's a so-called proof of work consensus mechanism. And all those technical terms you described, like Merkle trees, like hashes, cryptographic hashes that basically encode this information and make it secure and unbreakable, are certainly elements that are important. But for me, I would say would be subject to another format, let's say, to describe the functionality here with a number of slides, I would say. And for us here, it's important to understand that the functionality, or what is basically new under the sun, is that we can now transfer money over the internet, and actually in a wider sense, everything of value. This could be also IP rights, for instance. This could be digital artwork, as we have seen in the last 2 years with those non-fungible tokens, for instance. And we can actually do that from one person to the other, just as we exchange cash. And this was actually the initial idea behind Bitcoin.
Yeah, we went here a little bit further in the questions than we want. Let's try again. David, could you describe us a blockchain and basically what is Bitcoin and Ethereum, how it functions more in detail, that we can go later on to describe the underlying value?
Certainly. So that said, I do like the explanation that Oliver gave, because with a lot of these new technologies, you may not want or need to understand the kind of the inner workings, but you might, benefit from the utility. None of us is a particle physics expert, but we all use a microwave, that sort of thing. So I do think the utility that Oliver was talking about is very important.
With Oliver and you. It's just for later on describe better values and so on. The alpha value.
Totally.
It's
totally makes sense. So I think that well, first off, there are 22,000 plus different cryptocurrencies out there. So going into the inner workings of each and every one is a little bit beyond the scope of this talk. But that said, Bitcoin has roughly 40% market dominance. And then the number 2 would be Ethereum. Most people are familiar with Bitcoin and Ethereum. So Bitcoin itself was released in 2009, and it was designed to be immutable, which Oliver referred to some of the practical applications of that, with a primary goal of being a global currency and store of value that could be an alternative to fiat currencies and to gold. So the Bitcoin blockchain itself sends coins called Bitcoins on its network, and it has a fixed supply has a lot of features that we can go into in more detail. In contrast, Ethereum and networks like it were designed to do things that the Bitcoin network can't do or didn't want to do. So that includes things such as smart contracts that can basically conduct transactions around things beyond the transfer of financial assets. Also includes decentralized applications. So the analogy there being if Bitcoin would be like a smartphone, a decentralized application or DApp would be like an iPhone app that you download on the App Store, so to speak. Also, a lot of the things that networks like Ethereum have been enabling are movements like decentralized finance, meaning basically more optionality around borrowing, lending, earning interest, these sorts of things. So those are some of the functionalities and some of the workings that are useful to this conversation. In terms of some of the I guess technical functionalities of a lot of these networks, most of them are designed to be open. They're designed to be publicly verifiable. They're designed to be immutable, meaning that it's very difficult, if not impossible, to reverse transactions or to tamper with transactions in a ledger. They're designed to be decentralized, providing open access around the world. And they're designed to be of high security grade. So the Bitcoin network itself has to date not been hacked, which is not something that we can say of Amazon, Facebook, Google, etc. It's designed through its decentralized nature to have no network downtime, given that there are copies of the network essentially stored all around the world. And it's designed to be borderless, designed to be open source, and also designed to be trustless, meaning that it's designed to help conduct transactions in an arm's length scenario where parties are not well known to each other.
Thank you. Amandeep, do you have something to add to it?
Yeah, I think a lot of buzzwords we heard, so I'll try to put a story in a different way. Yes, if anybody understands the basics of data structures and computer science, there's a concept of hash, and the Merkle tree is basically where factor of 2, you have a hash of the subnodes. So anything you mess with that tree, the impact is at the root. So that basically makes any data structure, any data object kind of immutable in nature. If you change it, the visibility is seen across. So that's a technical. Now let's come back to like the basic world that we live in, like settlement, for example. Two bank accounts, when you're transferring money from one to another, a central bank is facilitating the interbank settlements. You are using mobile phone, you use roaming, you go to another country, international roaming calls you make. The two telecom providers are not settling with each other. They use something like a settlement provider, which settles this. You come to power grids. So for the power grid to be always functional at certain voltage, there are multiple providers who are kind of providing the power. There is a bids going on. And who is providing power at which interval of time is again settled back to them. Who is contributor? Who does it? We have concept of settlement providers. So these settlement providers have existed for a long time, and they are still part of the society and ecosystem. So what Bitcoin does is, first thing, it brings you a complete transparent transaction log on the entire network that these transactions have happened. You don't need a kind of a settlement provider as such to verify what all transactions happen, who contributed to whom. Second, when Ethereum came with smart contract possibility, now first it was a peer-to-peer exchange of a token, which was not even considered, like, let's say, monetary value, but it's a kind of a holding as an asset. Now with the smart contract, you can actually define based on this, which is basically kind of a logical capability. Based on this transaction, or you provide me this, based on this signing of this, you are eligible to get this. So this, if this and that. So if that can be coded, and what we call the digital asset can be transferred based on you fulfill certain obligation, there's a kind of an ecosystem we are talking about. Now, you might be coming from traditional finance, like you are so used to these settlement providers and this ecosystem. But here is something, I will not go up to like owning and setting up your node, but that's a good thing to start with. Even having a basic wallet or visibility to a Bitcoin transaction explorer can give you an equal capability of settlement provider. So you are as much possible to get able to do that. Plus you can monitor, plus you can contribute to the economy, contribute as a term of holding of asset, transfer of assets. This is the ecosystem enabled by what we call like Merkle tree hash based data structure on top of smart contracts. Yeah, this is, I will say.
Thank you very much. So I heard a lot of description and I saw it with assets, transfers, and so on. So could we agree, or is there something with disagreement, please, with this statement that it's just a decentralized database in its core, where basically we have centralized databases like SQL, and we have decentralized databases which you can store things in a more secure way because a lot of people can look at it and it can be verified and it cannot be altered. Is this a rough or correct description, or do you have to add there something to it, Oliver?
I would add something to it. I mean, it's certainly true that the decentralized database is a or distributed database. It's the core element of those distributed ledger technologies, where blockchain is, let's say, a subset here. But the important or very key aspect here is that it has become possible to define digital bearer tokens on top of these, or that are stored in those databases, and that the ownership of these digital bearer tokens can be transferred peer-to-peer, and this is enabled because the Bitcoin blockchain, with the Bitcoin blockchain, the first time this so-called Byzantine generals problem was solved, which is how to establish consensus among a number of actors that don't know each other, that don't trust each other, and that are not coordinated via a central authority in a way that every one of those actors can be sure that he receives the correct information, that he holds and receives the correct information. And this is really a key problem, because of this, has become possible to avoid the so-called double spend problem, meaning, for instance, if I send a picture or so by the internet to you, I always keep the original, you get a copy or a file or something like that. That's a very bad idea for anything of value, for money in particular. And this distributed ledger, the database you referred to, has, through this cryptography and these elements that have been described, properties that it's tamper resistant, that it's time-stamped, it's auditable. You can actually audit what happened in the past. It's clearly documented.
Okay. Oliver, so I understand that, of course, solving the consensus problem. And I mean, it's a nice story about the Byzantine channel, which was giving and had a problem how to send the messages out when you have one trader in. And I mean, this is nice to look at for our audience. It's a really nice story. Please look it up. And I'm happy that you brought this, because this is a core point of consensus problems. But now when you speak about the Bitcoin, So the core functionality for what it is it used as a currency, or is it used, the original usage is more geared to be used to store assets in, or is it used to replace money? If it's used to replace money, how can it replace money when the current transaction speed takes a half an hour or an hour to have the money, and credit card goes quick, and it could not even handle all the credit card transaction in Switzerland, and now we want to do it worldwide. So basically, when somebody from our 6 billion people would order a sandwich, he would get it in 3 months. We would all starve. So, question,
I take that.
Is your argument that Bitcoin is worth something because it's money, and we all have to wait 6 months till the payment goes through when we all change to it? Or is it a database which you can save NFTs and so on? What is the intrinsic value of Bitcoin?
I'm happy to take that. And you brought up a key point. We have to, first of all, among those 20-something thousand cryptocurrencies, I don't particularly like that term, actually. We have really to distinguish Bitcoin and all the rest, because not only because it's the first, because it has been designed actually, or the intention was to design a peer-to-peer electronic cash. However, the actual functionality of cash today can be realized, or could be realized, by a so-called layer 2 solution. In a Bitcoin case, that's called Lightning Network, which is much faster, and could transfer this asset, this currency, a Bitcoin or a fraction of a Bitcoin very fast. However, the key question remains, does that make sense? And for that, it makes sense maybe to look into what are currencies and what is money. Currencies are, first of all, a medium of exchange that enables us to basically value, having or attach a value, a unit of account to goods and services. It is, currency is portable. I can take it with me. When I look at a dollar, for instance, it's durable. It's also not, it doesn't perish. It's divisible. $1 is divisible in 100 cents. It's fungible, so it's interchangeable. $1 is my dollar, or my $10 are as good as your $10, for instance. Now, money has one additional property. And this property is the so-called store of value. And if we look at the currencies like US dollar, euro, yen, etc., the challenge here is that these currencies lose value over time, lose purchasing power over time. Recently, inflation picked up a little bit, so we have loss of purchasing power of around 9% or so, and the reason for that is certainly multiple. But one reason is certainly that the issuer of those currencies in the US, the Federal Reserve Bank, is bringing more of these currency units into circulation. And if you look at it from a global perspective, you can say that all goods, all money that is out there is equal to all assets, everything of value in the world. So if you increase the supply of monetary units, and keep the assets, everything which is of value, stable, it simply means that the nominal value of the assets, for instance, of a house or of a company, a stock, a share of a company, and so goes up. And this is more or less also one, let's say, key element in the thinking behind Bitcoin, that the anonymous creator of this currency, Satoshi Nakamoto, we don't know whether it's a person or a group of people, they thought that it makes sense to create a digitally scarce good, yeah, where a limited number of units come into existence. In the case of Bitcoin, 21 million, and the actual creation of additional currency units is mathematically predetermined, yeah, and it cannot be manipulated. Now, there are a number of problems associated to the use of Bitcoin as a currency, as a replacement for a US dollar or euro or yen, because it takes away the opportunity of governments and nation states to stimulate, for instance, an economy, for instance, in times of crisis.
Oliver, we go a little bit off topic. Like, can we stay more?
If I could just add to, a couple of relevant stats to that conversation. So, as Oliver was saying, I mean, the two main points that Oliver was making was talking about Bitcoin and other cryptocurrencies as a means of transaction, means of commerce, and then also talking about these currencies as a store of value. And so when it comes down to the commerce side, back to Carl's question about transaction speeds. So with the Lightning Network, it's actually possible for, if all nodes are of the Bitcoin network are participating in the Lightning Layer 2 solution, it's possible for the Bitcoin network to achieve transaction speeds up to double that of Visa. So in that regard, there is inherent scalability in Bitcoin. But beyond that, Bitcoin is, as Oliver mentioned, the first, and it's not necessarily going to be the last. There are solutions that can, other cryptocurrencies that can handle transaction speeds up to 50,000 times faster than Bitcoin, which is pretty significant. And that becomes also much faster than a network like Visa. On the store of value side, I really agree on the inflation points. And I mean, I've been in crypto since around 2016, 2017. And even back in the day, I found it fascinating that many years ago, there were 15 countries around the world that had 15% or higher inflation. And that encompassed roughly 5 to 10% of the global population was undergoing over 15% inflation. Now it's closer to 50 countries with over 15% inflation in the wake of COVID and the resulting economic challenges. And that is really more representative of close to 25% or a quarter of the global population. So when you take in mind the counter-inflationary or deflationary policies and tactics of a lot of cryptocurrencies as stores of value, this becomes all the more relevant of a use case in the current climate.
Yeah, David, if I might chime in here, the problem with that is nonetheless that the purchasing power of Bitcoin is actually very volatile over time. So roughly a year ago, one Bitcoin was equivalent to around 65 to 69,000 US dollars, and you could buy stuff with it. Today, it's maybe $24,000 or something like that. So it's actually not so predictable, and therefore a Bitcoin for me actually has much more value in the sense of an asset that you would add to my balance sheet, yeah, and I have to clearly separate that from my, for instance, from my profit and loss statement, yeah, where I look at where do I get my revenues, what do I spend for my daily expenses and stuff like that. There it makes sense to hold a US dollar for a certain period of time. It's pretty predictable that I can buy tomorrow a coffee for $5 or something like that. And next week it will be roughly the same. And maybe in a year's time, it will be $5.50 or so. That's pretty predictable. Whereas it's not clear when I would do that in Bitcoin. But people buy certain assets as a store of value like for
Oliver,
instance, real estate and stuff like that, or diamonds
Oliver,
and so on. Mm-hmm.
just for clarification, because you speak Bitcoin as an asset. What is the asset? What is the asset from Bitcoin? I mean, you speak a Bitcoin just as a Bitcoin,
The asset,
and you say it's an asset. So
exactly. It's a digital asset in the sense that it was possible.
When I understand, you say you want to store this digital asset by you, but I mean, it could be also, I mean, what is the value from the asset? I mean, where you store it.
What is the value? What is the value?
I take something.
What is the value of gold?
Can you define more the asset? Thinking about this asset, why it's an asset?
Yeah. Okay. Why is it an asset? Because that's a very interesting question and aspect.
No, I mean, just a bit for the audience right now. I know exactly what you mean with asset because of the whole complexity of Bitcoin behind it. But for the audience, it could be like, yeah, I write a computer file like a Word document, and I write in hello, and I save it, and this is now an asset which I see. Right. I mean, like when you see sometimes
so that raises
which take stones in the wall or rope and say these are my assets. Why is it not stones in your wardrobe, which you now say are precious?
But if you talk about digital assets, for instance, you could speak. For instance, you have an analogy with intellectual property rights, for instance, with a patent or something like that. That is just words in a digital file. Yeah, it's an asset nonetheless on the balance sheet of a company, for instance. And in the case of Bitcoin, it's also a digital asset. And the interesting thing is that you can define, or it is let's say, we can say with absolute security that it was possible to define a digital scarce asset, to define basically exactly a scarce asset, and this gives it properties, this digital element, which is hard to grab, let's say properties that are at least comparable to other scarce assets. Most likely, or the closest digital asset we can think of is probably gold or diamonds, things like that, that cannot be artificially generated, in the physical world. So basically, Bitcoin has the potential to dematerialize, at least partly, the function of gold as a store of value, the function of real estate as a store of value, because, for instance, you can see that in Paris or also in Berlin, people buy real estate, they buy apartments, and nobody lives there. They just do it because they want to store their value. Yeah.
So to that point about stores of value, though, just for other kind of statistical context, to Oliver's point, the silver market, the market capitalization of silver is roughly equivalent right now to the market capitalization of all cryptocurrencies. So in that regard, there is a proven traction, as compared with something that has been around for millennia. There is proven traction around digital currencies as a store of value. And to the previous point, though, about Bitcoin's volatility as related to inflation, I think that's where it's important to look into what an investor's goals are, because something like gold, yes, is not really going to necessarily function as a direct prevention against inflation, in the sense of, I wouldn't personally park the money that I was, trying to buy bread with in Bitcoin, but I might choose to park it in a regulated stablecoin that had significantly less of an inflationary history than my own currency that I'm using in my country. If my country's currency is inflating at 50%, and let's say a US dollar coin is inflating at 10%, then I might choose to invest into those types of assets. So then it comes down to, are you looking for something like Bitcoin, which, yes, isn't necessarily going to be directly utilizable in the commerce situation, but could hedge against and be a means of diversification in the midst of inflation and volatility in stock market and real estate? Or are you looking for perhaps other digital assets, such as a stablecoin, which could more directly help to curb some of the issues with inflation?
Thank you. I try to move it ahead. Okay, Aman and then Deep, please. Yeah. You didn't speak for a long time, but let's move ahead because we have a lot of subjects to cover, and we are only by the first questions. So please go ahead.
It's me? Okay. If I can just add to the asset part. So like, yeah, there's a scarcity element to it. 21 million is max limit for a Bitcoin. And then it's like, if you're fleeing a war zone, what's the best thing you can carry with you? Like a suitcase of dollars, like a brick of gold, or like holding a wallet private key, which is decentral. You can access anywhere in the world. You can exchange, you can sell that onto any exchange, get the local money back, and plus at any denomination. You don't have to sell the whole brick of gold. You can sell by fraction. So that gives the asset element to it. No doubt, it's the scarcity and the volatility in the other capital markets, other currency markets can come into play. Then over the period of time, we have seen, yes, the asset, if you see the asset as a value of Bitcoin fluctuates, yes. There's another story to that, why other currencies stay stable, but let's not get there. But the idea here is that, does that give you flexibility of owning an asset to wherever you want to carry it, where you want to sell and exchange for whatever you want? It fulfills all the properties. So now the question comes, how much percentage of your portfolio you should have in such asset? That's the question, again, comes back to like in when you kind of get to decide. Yeah.
Maybe one last thing I would like to add, Carl, before we move on. Again, we've been talking a lot about Bitcoin, and now we have all the other, let's say, roughly 20,000 digital assets or digital currencies out there, which are largely issued by startups or companies that build applications on top of blockchains. Yeah? And oftentimes, these digital assets have a certain utility within those applications. In the sense of Ethereum, the Ether asset on this network is a sort of a fuel that gives you access to compute power. Yeah? For Filecoin, for instance, it gives you access to file storage on a decentralized database. For Helium, it gives you access to IoT data processing and things like that. So that's fundamentally different from this Bitcoin asset and the variants that have been there. There have been forks around like Bitcoin Cash and others that didn't gain that much traction. Yeah, but that's really fundamentally different. So when you invest, let's say in Bitcoin is one thing. When you invest in Ethereum and all the others, it is, let's say, a different story. It is more like investing into a startup with a certain product and service that they provide. And you are basically betting on the success of such a startup, as you could bet like 25 years ago on the success of Amazon, for instance, which would have been a good bet. But others like Yahoo disappeared. Yeah.
Okay, thank you very much for this input. And basically also, I have to say a lot of people agree with you. So we ran a survey yesterday to have the newest market data. It was 10,000 people responding. So 31.4 people invested in the crypto. 23% of the people invested in stocks, crypto, and other things, and in stocks 19%. So basically, we have a huge chunk of people which exclusively invested in crypto, which was 23%. And in crypto on stocks, from everyone who holds stocks, 25%, the same number, invests in cryptocurrencies also. So we have a steady investment in cryptocurrencies. Now, as fund providers like ChainBLX, we have to also look at other aspects. One of these aspects is, for example, ESG. It's like, how is it socially and so on? How is it acceptable? So before we let a person start a fund, we have to look also on ethical aspects. And there comes, of course, a question of by Bitcoin and cryptocurrencies, which may be, for example, the electricity consumption from Bitcoin. So when you think that the CO2 production of Bitcoin is equally than the CO2 production of twice Los Angeles or one time Switzerland per year, just to mine Bitcoin. Is this high electricity cost really socially responsible? Let's start with Amandeep first, and we go the right, like David and then Oliver. Okay.
Well, first thing is like when this argument starts, I think that is the first thing that now Bitcoin is accepted as an asset. So I think that should say that. So now somebody is seeing this as an asset, and now somebody is also looking at how somebody else is obtaining that asset. And then the finger pointing and moral policing begins. Let me say this. So now, any currency or any resource, anything which you're mining, lithium mining or any other mining, yes, there is a kind of a lot of impact on the environment. There is a cost associated till the final product comes out. As Warren Buffett also said about gold, like it's taken from one mine and finally refined and put into another vault. So what's the use of this? But for the current society, it defines the store of value. Oh, sorry. Did you say something? Okay. Yeah. So when we say the impact, yes, if you're using what you call too much of electricity, which is coming from non-renewable sources with a significant dent on the environment, yes. So your cryptocurrency, which is mined, has an impact. But is there a kind of a good argument, a solution to that? Okay, let's mine everything what we can do in where there's a volcano giving heat and electricity, or where there's a geothermal power in Iceland. Does it give a kind of an answer to that? Probably not. Then there's also a conversation on proof of work and proof of stake. Yes, what we are talking about mining is like proof of work, where this kind of computing power has to be burnt using the electricity, and to actually somebody can get into the ecosystem. Proof of stake is another way of owning or getting into that limited supply of stuff. As an incremental supply coming in, you become the owner of that. We can get into a different moralistic argument of what is proof of work, what is proof of stake. But right now, proof of stake looking like a morally better alternative, more scalable, but it also makes the asset fungibility and assets overall landscape ownership in hands of a decision of those entities who already are in that ecosystem, who have a stake in that system. Somebody cannot just enter in and start mining and start getting. So that's my take on this.
David?
Yeah, so I think some interesting points there, and working backwards, proof of stake. So I agree that this does seem to be one direction in which the cryptocurrency industry is evolving into a even more environmentally friendly direction, and roughly 30% of the market cap of crypto globally is represented by proof of stake. So to that point, you have a very strong contingent, which is just night and day more energy efficient than something like a proof of work network such as Bitcoin that is using just the tiniest fraction of the amount of power. That said, thinking through specifically, the environmental argument about crypto tends to be focused on the more the proof of work networks, especially Bitcoin. So specifically, though, that there have been some interesting studies on that. So for one thing, there was a NASDAQ research article that came out not too long ago that talked about the Bitcoin network consuming less than half the energy of the banking industry or the gold industry. And so that's something to be taking into mind. I think that there are some flaws with that study, but it's an interesting counterpoint nonetheless. Relatedly, also around 60% of global Bitcoin mining energy or energy devoted to Bitcoin mining comes from renewable resources. So really then, if you factor in for taking 60% coming from renewable resources, and then we're also factoring in that 30% of the market cap is proof of stake, then this becomes very much the minority of power usage coming from environmentally unfriendly areas. And then within that, within these, let's call them the so-called environmentally unfriendly sources of power for Bitcoin mining, roughly 60% of those, or rather, of that, a lot of it will come from resources such as surplus energy. So, for example, from gas-powered mining, that comes from surplus. The alternatives in mind would be tactics such as flaring or just burning that gas. And in this case, using that surplus energy for something like Bitcoin mining is actually up to 60% more efficient. So overall, when we talk about kind of significant environmental issues and concerns, when taken into scope, they become a very, very small piece of the overall pie.
Thank you, Oliver.
Yeah, very, very, very good points, David. I just looked up a few numbers here on the website here of the University of Cambridge. They have a very good department looking into crypto and energy consumptions in particular. So you might want to look that up. And there you can find, to your point, David, that the global gas flaring recovery potential is about 690 terawatt hours of energy. That's 6 times the energy consumption of the Bitcoin network. So what does it come to? And there are several other waste energy topics covered there. So what it all comes down to is it worthwhile to have such a thing like Bitcoin? Yeah, in the first place, does it make sense? Just like, does it make sense to have Google and search for stuff? Or does it make sense to have games or whatever you want to take? Does it make sense to have US dollars as a medium of exchange? To print it, to issue it, to transport it, to have the banks, and so on. Does it make sense? I would say for currencies like dollars, euro, etc., we can say yes, it makes sense, it facilitates the economy, and so on. Now, in the case of Bitcoin, I would say yes, it makes sense. Why? Because it is, let's say, an alternative currency, an alternative asset that is not controlled by nation states, and the pure existence keeps, so to speak, the governing bodies, for instance, the central banks, in check, because you always have the option, basically, to take your assets out of the fiat currency system, for instance, the dollar system, the euro system, or in Nigeria, for instance, or in Turkey, yeah, where you have 80–90% inflation rate, or in Lebanon, yeah, Argentina. And the central banks will think twice or three times what they do with the inflation of the currency and with their monetary and fiscal policy, if they face the danger that people just basically turn around and leave their system. Yeah, this won't happen. I believe it won't happen, but the pure existence of Bitcoin actually is a hedge against that. And therefore, Bitcoin is, so to speak, it is ethical, I would say. You can justify that it makes sense to spend all this energy, also the waste energy. I mean, there's a lot of waste, so to speak, in this proof of work consensus mechanism. The advantage of that mechanism today is that is the so-called censorship resistance of this mechanism is higher than in the proof of stake systems, and especially in the sense in the case of Bitcoin that has more a commodity character. It's looked, by the way, it is seen by the regulators, particularly in the US, as the only cryptocurrency that has a commodity, clear commodity character, yeah, not a security character. Why? Because there is no issuing legal entity, and there's no one person or one group of people that actually govern it, yeah, that can decide what is happening with it. And that is why it has similarities to gold. It has similarities to other commodities like silver, copper, whatever you want to take, oil, yeah, air, water. And this is the actual innovation and the fascinating thing about it, that it is a non-material thing, just like, for instance, this iPhone here dematerialized, or here I have it, it dematerialized the physical mail, it dematerialized the calculator, it dematerialized a lot of additional things, more or less, the agenda, whatever, we have our calendar in there, and so on and so forth, yeah. This thing, this digital currency, this Bitcoin, dematerializes, at least to a certain extent, these commodities like gold, or are an additional asset in that respect.
Okay, thank you. So, of course, it has to always see the benefits for the consumer with all ethical considerations, and if it's worthwhile, the expense. And there were also some publications when we saw tokens which used blockchains for CO2 trading, and there was a lot of publication if it's worth the energy and not. And I would, our audience, recommend to look up this research, make their own opinion about this research. And of course, good research is always controversial discussed. So let's our audience also to look it up, but there is no way we can say the argument the energy consumption makes Bitcoin invalid. This argument doesn't exist, but it doesn't also exist that it can be said that it's not a concern. In today's world, energy is a concern. So let's go ahead to the next questions. Oliver,
one topic, Carl, because you just mentioned the topic of carbon certificate trading. Here I would clearly say it does not make sense at all to do that on a proof of work cryptocurrency. You would always proof of work currency. You would always use proof of stake cryptocurrency or proof of stake blockchain to register basically these types of tokens and to transact them, because that's 1,000,000 times more energy efficient than a proof of work system, but not for the currency fund. Yeah.
You don't want to also.
You would hardly find a carbon certificate that is traded on a proof of work or generated or traded on a proof of work system.
In related environmental tips, don't fly a private jet to an environmental conference. Yes.
Exactly. Yeah.
Amandeep, I would like to give you the next question, and this would be about the market adoption from blockchain technology overall. And there were similarities which are given out for what happens during the internet revolution, and also big differences between what happened during the internet's revolution. Just to set a framework, the internet was invented January 1st, 1983, but it was in August in 1991 where CERN was creating the first website. But when we see the development from the first website to basically the full-blown up market, which was going up to $6.3 trillion by 1999. 1994, for example, like only 3 years after the first website, we had already Yahoo in the marketplace. And we had AOL a little bit earlier, and we had the whole crazy internet boom. Now, my question is, when we look at the adoption rate from the blockchain, and we see it started also around 10 years ago, and in the internet, we had 10 years ago, right now, when we compare it to the same time frame, we would be by 6.4 or 6, 1 second, I have to see the data correct here. How many $1 trillion was it? Yeah, it was
market cap of crypto?
Not of crypto. Crypto is 800 billion. And
a trillion.
Yes, and the internet was by this time by 6.4 trillion. So the market adoption was a little bit slower by blockchain. So what speaks for this slow but also still quick market adoption, Amand?
Yeah, I think as a society, as a human being, we need some jerk reaction around us to kind of switch to something else as another medium. So I just actually posted a link to a Zoom call. Maybe YouTube can be reposted. So basically how the DeFi market exploded, how the PayPal reported, for example, the highest number of adoption segment, it was 50+-year-olds. So, and now with the, I will say that I originally come from India, so it's a de-dollarization world which is going on. India, for example, launched its payment integration platform, instant clearance with Singapore yesterday. And the same platform is actually built if in case it has to be done with Indian and Russian rubles. So those platforms investments are kind of first indication that we may be heading to a world with less use of US dollar. So that can lead to kind of a massive adoption. And cryptocurrency stands as a huge candidate for its clearance capability. Then it comes as a society. If a cryptocurrency like peer-to-peer transactions are possible. Peer-to-peer settlements are possible. There's no need of a kind of a third-party mediator, settlement provider. As and when the use cases arise, as and when there is a kind of you and me sitting to decide, let's trade this in this cryptocurrency instead. So why not? There is a kind of a case. Other thing is that education and hype around. Most people jump onto a cryptocurrency project right now, not knowing the technology, not understanding the applicability of why this blockchain is better than the other. But it's basically like this coin, I'm buying at this price, and this coin price will rise. And this is why I'm getting into it. But if somebody has gotten in at that stage, if that person or entity can also be explained or educated that what's the kind of a like a transaction value other than this the holding value, there's a whole transaction ecosystem which can be built. If now there's a lot of investment going on in low code platforms. Basically, you write your own smart contracts with your friends to kind of transact. I see very good projects actually building up in that side. So I see a big case of adoption coming, but it's all happening in fragmented bits and pieces. It just does not need some economic disasters in some economies or some wars, but that also contributes basically.
Yeah, so I think also it's important to bear in mind that different technologies take different periods of time to be adopted, and just relatedly, I mean, I guess the internet. If you compare the adoption speed to the internet, then I think blockchain kind of comes out as a slower adoption rate. That doesn't necessarily mean one thing one way or the other to me. I think that an interesting analog to bear in mind is just thinking through average adoption rates of groundbreaking technologies. And they tend to be in the decades overall, even thinking through the history of the last 100 years. So thinking through things like the refrigerator, even that was invented around 15, 16, 17, something like that. And then really only reached 90% adoption in the US at around 1950. So over 30 years, things even like the landline, the automobile, various in general tended to take decades. Even things, I think that the refrigerator is interesting though, because it is something that, speaks to people's everyday eating habits and actual health. And even that ended up taking a very solid amount of time. Thinking through electricity, running water, et cetera, even in developed countries, also these things have taken time.
Yeah, true. I would say, as far as when I interpret the numbers that I see actually a pretty analogous adoption rate to the internet as a technology. And what's always striking is when I look, it can be found on the internet, this interview with Bill Gates, I think at the end of the 1990s, where he was asked on TV, what's so special about the internet and what you can do with it. And if you look at that now from today's perspective, knowing what we have seen there with the Amazons, the Facebooks and more, and what this brought to the world, it's rather almost unbelievable how people looked at it. So I'm actually pretty optimistic that we will see a lot of innovation coming from blockchain technology beyond this aspect of a use as a currency or a store of value, but as a technology to replace manual trust provisioning and verification, synchronization services, because these processes within companies, for instance, they are moved to software. They are embedded into software, so to speak, dematerialized and therefore made more efficient. And this is across the board. For instance, in the financial services industry today, used. It's used in using companies without actually using currencies in many cases or coins. Yeah, and beyond that, we will see a lot of use cases about our products and services that make use of blockchain technology and tokens as incentive machines, as incentive mechanisms, yeah, that make people do things. Examples, I mentioned already a few, I think, here with Filecoin, for instance, where the currency in the system incentivizes you to use this technology or this platform basically and use it as a file service, and many more. We have seen this, for instance, in this whole NFT hype in the last 2 years, where the more or less other in the broadest sense, assets like cultural values are tokenized. Yeah, we will see it in tokenization of traditional financial instruments like shares, like bonds, like ownership of real estate. I'm pretty convinced that we will see solutions here in the next 5 to 10 years that will revolutionize what we have today, make those assets more liquid, and therefore, let's say, contribute to a generation of wealth across the globe, because liquid assets are actually more valuable than illiquid assets.
Thank you, Oliver. And okay, so from ChainBLX point of view, also we looked at what we think it's, and I would agree there with David that, of course, different technology have different adoption speed, and we can really not say that it's a slow adoption. It's adoption. There's a lot of similarities. Both are really disruptive technologies, opening different ways how people conduct business and interact with this other. And this, the most important, on a global scale. The internet brought the people together globally with websites, and then later on with Web 2. And this is a financial regulation, also finance and decentralized companies. What we as ChainBLX saw in our analysis is that, of course, the internet relied on the financial institution which were already given. The Security Exchange Commission, they were going public, investors were coming in and built up the companies with a goal for IPO. So it was falling in the traditional financial system, which was supporting the internet growth. By the blockchain, we have a revolution, not only in the technology with Filecoin and all the other companies building on top of blockchain, really good things, but also within the blockchain, how people try to raise money. Instead of making a private placement, they started to make token offerings. The blockchain directly influences how the final institutions will and want to conduct business. And this is a little bit the difference for us, which we see in the adoption rate, because it's quick to adopt when you use the financing which exists already, and you don't go against the status quo there. But blockchain goes also there against the status quo. And this was making the adoption rate a little bit slower, also when it's technology comparable to the internet in many ways. but it made it also maybe in the future a bigger revolution even than the internet. Do you agree with the statements? Let's start from Oliver, David, Amandi.
Yeah, I would definitely agree also to your to the last sentence that the revolution will probably be bigger than the internet revolution, because of the aspect of tokens and digital property rights that have huge potential as a nucleus basically for new business and service models that we see, and also for in the sense that it is used as an instrument to raise funds, for instance, and to invest into companies. Yeah? The important aspect is also that it makes such investments accessible to a broader set of investors if the regulators actually enable that. For instance, VC investment, venture capital investment has been traditionally only accessible for qualified investors, for rather wealthy investors. Investments in sports assets, for instance, in a team, an NBA team or something like that, is probably accessible only to billionaires. This might change in the future, and it might be accessible to a broader public here. And therefore, I am very optimistic that we will see a lot of innovation here once the whole UX UI is updated, and also once the regulatory environment enables such innovation. I think that's a pretty important thing. And coming to the point of investments, it's also clear that many of those offerings that we have seen are in fact securities that should be regulated according to the existing or further developed regulatory frameworks we have seen.
So to that question about, I guess, which is bigger, the internet or blockchain? I mean, ultimately, time will certainly tell. But is Bitcoin? Does Bitcoin have the potential to be bigger than the internet? Maybe. Does blockchain and crypto as a whole have that potential? I would say very probably. So, I mean, just for example, the World Economic Forum research projections estimate that global asset tokenization using blockchain and cryptocurrency will be at approximately 10% of global GDP within the next few years, before 2030. I believe they even said 2027 even, within the next 5 years. And that even only takes into account some of the use cases of blockchain. So tokenization in and of itself is not the entire picture of blockchain potential to impact growth and GDP. So factoring in those aspects, I think very much that there is that potential. I liked what Oliver said a little bit back about basically that the innovation will likely take place in cases outside of original designs or something to that effect. I think that bearing in mind basically potential of the internet and such, and that point from Oliver, I think it's a good analog to the mobile phone industry. So thinking through phones and even cell phones, really the explosion in the economic impact of phones and cell phones happened not because of using them for calls, but because of using them for literally anything and everything else, basically. And so similarly, the potential of blockchain, very much lies not just in Bitcoin, but also in other cryptocurrencies, in asset tokenization, and in multiple other use cases.
Yeah, if I can add to that, like where I started, like once we see these settlement providers kind of disappearing, that's a kind of a case where it's building in. You have the property documentation, asset ownership, the fungibility and non-fungibility, non-fungible being your actual asset, which is minted for you, coming around us. That's a kind of like a game changer. I'm surprised nobody, not even you, Carl, brought CBDC at this point. CBDC is also looking like or trying to mimic the adoption in a different way. But let me not dilute or pollute this argument that for us as a technology adoption, if a use case of ownership, if a use case of transfer of ownership, if a use case of non-fungibility, it becomes easier using crypto, so be it. It is eventually there. Then. Yeah, that's what I would say.
Okay, thank you very much, everyone. This concludes the first part, and I would like to just give a minute for everyone before we go why you should add or why you should not add cryptocurrency to your investment strategy or in your portfolio, and how long you should hold it, if you should hold it, and different investment classes. So this is an investment class. Before we go there, I want everyone just in 1 minute to say some widespread misconception about cryptocurrencies and like tokenization. Let's start with Oliver, and let's go quite quick through, please. Or let's start with David, because he's in the middle. He's never getting it by my screen. I see all of that like this. I start or by left or by right, and David never gets the first question. So David, you get it first, then Anandip, and then Oliver, or then Oliver and then Anandip. So who then is quicker? Okay.
All right. Well, in terms of misconceptions, I mean, I think that one major area is crypto as let's say illicit activity, money laundering, etc. And while there certainly is this does occur with crypto, it also does occur with multiple other asset classes, very notably cash, real estate, businesses, etc. And so even just in terms of absolute values, as well as arguably in terms of percentage values, multiple other asset classes are more susceptible to this issue. Relatedly, this idea that everything is completely anonymous, which also ties into that idea of illicit activity, is not the case. So for one thing, it's important, I think, to note that most cryptocurrencies are pseudonymous and not anonymous, which does mean that activity can be tracked. And also that there are just a whole lot of technologies out there that are collaborating with various government organizations and such to track down flow of funds of illicit activities. Relatedly, also, along that overall theme to Amandip's question about CBDCs, central bank digital currencies, I think that there's often kind of a false dichotomy posed between CBDCs and essentially independent cryptocurrencies. A lot of the expert research really points to these CBDCs being a good thing for the overall adoption and usage of cryptocurrency and blockchain in general, not just within the confines of CBDCs, but in terms of essentially the government activity being something that can provide a positive influence on the private sector development of such technologies. So there are many misconceptions, but I think that overall theme is something that's important to note.
Well, I agree to more or less everything that has been said, and might add here maybe to your point with CBDCs that here I see really some dangers, because the technology actually enables a few use cases that we don't want to see. For instance, your money could expire. You could be forced to spend it. It loses value, things like that. That's not, you cannot implement that with cash. Yeah. You can implement it with a central bank issued digital currency. And that's why, for instance, it's important that currency like Bitcoin exists, because it will prevent the central banks to implement such a technology. In terms of misconceptions, I would certainly agree that it is in the public domain, the fraud and illicit activities have a lot of room in mainstream media. That's good to a certain extent. However, we also have to take into account that we've seen a lot of fraud in the traditional financial services industries. I looked it up today, actually, that post 2008 financial crisis, the global banking system was fined $330 billion US. Yeah, 330 billion for committing fraud, and that's a big number. It's actually not the global system. It's actually only the US. It's not the global system. Only the US. 330 billion. Yeah. And if you compare that to the FTX case, which certainly was not a very good event here for crypto, there we're talking about a damage of probably in the region of 8 to 10 billion or so. Yeah. If you compare that to Bernie Madoff, to Enron and other fraud cases, or in Germany, you had one of the top 30 companies, Wirecard, being a complete fraud payment provider, complete fraud, one of the top 30 companies in Germany. These are topics that are not adequately discussed and represented in the public media.
So just thinking through some of those stats in terms of their relative magnitude, I mean, that roughly 330 billion in fines for the US alone, if the US financial industry is worth roughly 4.5 to 5 trillion, and contributes around 1.5 trillion to the US GDP. So thinking of those $330 billion in fines, relatively speaking, it's around 7%. Those fines are 7% of the overall worth of the US financial industry and around 22% of the GDP contribution to the US economy, which is very significant.
Yeah, but it's also a longer time. So it was, I think, from 2008 to today, the total fines. Yeah, so
interesting.
Be careful here, but still a huge number. And certainly, I would not recommend if somebody is a criminal and has criminal intentions, I would not recommend to use blockchain technology to carry out those transactions, because you can track and trace it with the let's say with an effort there. We've seen that, for instance, in the Silk Road case and several others, this darknet marketplace. When the authorities put in a lot of work, you can actually track down the individuals.
If I just add to that, CBDC. Okay, let me jump there first. The misconceptions, yes. First misconception is around money laundering. Yes, that it is a tool. And I can even quote a recent example from India, where India kind of like hit hard on some Chinese companies not paying taxes regularly. And 3 of the top crypto exchanges in India are criminal investigation, because then these companies use these Indian crypto exchanges to siphon money out of India, which was not easily possible. So this all happened in the last 1.5 years. What shall we do about that? Can we just prevent anyone to open a crypto account and kind of start moving money in? Should we make the exchanges liable? Should we make the individuals or the entities liable? Should we make the process so hard and difficult that nobody even tries? Or should we start taxing everything at like 70%? That nobody's kind of even thinking of speculating or getting into or adopting. So these are some questions which are also coming along with adoption. But I will say that this is the very Western world misconception is it's like kind of fear is around the use of black energy and spending too much of resources, and the money laundering part exists where the countries which are kind of striving to access resources, the relatively the poor part of the world. As a society, as an individual, as somebody who wants to kind of build a system or kind of use that as a transaction system, is government or any kind of entity or any regulation coming to that way in a very derogatory way or very blocking way? I don't see anywhere yet. Rather, it's actually promoted as part of an innovation ecosystem. As yes, you can do that. What kind of remains is a kind of a healthy balance where concept like the whole concept of ease of transaction, ease of transfers, ease of availability is not just gets hijacked by like some CBDC and the rest of the projects just stay as kind of in innovation accelerators and not beyond. Yeah, I will say.
Okay, thank you. So, of course, there is a lot of myths in blockchain around, and in cryptocurrencies, one which also ChainBLX sees is mostly what David was emphasizing on, that everyone thinks it's not, it's totally anonymously. Yes, but every transaction can be verified, and this is even that you have a better picture than people use cash, what happens and how transactions were flowing. The second thing is, yes, David was correct, and most concerns from due diligence, anti-money laundering, when we look at hedge funds and so on, is for funds investing in other asset classes like real estate and so on. There, it may be also really, it's not unique to blockchain. I would like to go ahead with the next question, and now we have private offices following these conversations, and probably they are wondering when we were coming to this part. So should crypto assets be a part of a diversification? First of all, I would like to go, what are the traditional investment models? Say, should you put crypto assets in? Yes or no? Let's start with Oliver, and then David and Amanda.
Also, short answer is yes. Any serious professional or even private investor should add crypto assets to their portfolio. Definitely some Bitcoin, probably also Ethereum and some of the other currencies. However, with the others, it starts to get riskier because you cannot predict today whether they will be around in a few years from here. And this is, for instance, the point where I'm currently working on with my team on ways to assess token projects early on, whether their tokenomics make sense, whether they are as a project, as a team, let's say, a good investment, and whether this whole business model behind it actually will generate value. But the answer is certainly yes, invest in In the liquid market, I would also invest and advise at least larger investors to invest in the VC market here. However, it is clear that you need actually insights into that market to take the right decisions. And it's certainly not an investment that you should take, let's say, with the intention to make a big profit in 2 or 3 years. Yeah, this might happen in the liquid market. This might happen, especially now. But it can easily be that you should hold on to your investment like for 5 or 10 years until it generates decent return. Did I roughly cover your question?
David?
Yeah, so a couple of related points. So to that, I think Oliver said something a while back about basically the range of Bitcoin versus other cryptocurrencies. And just to put that into perspective, Bitcoin itself has a market cap of around 500 billion right now, and the market cap of currencies that are around the 1,000 rank on the overall coin market cap listings is around the that would be I believe it's around the 500 million range, or no, actually it's 50 million. So that's 1%. So basically something that's at 1,000th rank is at around 1% of the market cap of Bitcoin. And bear in mind again that there are around 20,000 plus different cryptocurrencies out there. So there is a very, 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 very long tail to this market, and it's kind of analogous to basically all of those. It's almost as if you have within the overall same exchanges and trading networks and stuff. It's almost as if you had exposure to something like early stage startup equity all the way to Fortune 50 companies, all within the same market in terms of the difference in the size of the market caps. And so in that regard, yes, I mean our overall approach, I mean, is to treat the different sized, different maturity crypto assets differently. So there are blue chip crypto assets, and there are kind of more like the penny stocks as well. And we find that in many cases they serve different roles in a portfolio. More the higher asset or higher cap ones tend to be a little bit more stable. The lower cap ones tend to be more volatile, which can lead to very, very accelerated returns, but also in general can provide more risk. But in that regard, I think it's important to think through what the goals are, what the time horizon is. So in general, a lot of crypto experts will ascribe to 4-year market cycle theory in the Bitcoin and crypto markets. So in that regard, in terms of holding various assets, many people tend to focus on 4, 5, 6-year time horizons. That could be different though if dealing with different strategies. So something more like a crypto and blockchain VC fund, or basically investing into equity positions in crypto companies, might have a time horizon of more like 10 or even 15 years. Whereas something more like a day trading quant fund might have a much shorter time horizon. Also thinking through just who's doing what, I think it's interesting to just see people voting with their feet. So it's over 90% of high net worth individuals under the age of 40 that have some exposure to cryptocurrencies and digital assets, and even those over 40, it's actually still in the majority. I believe it's over 60%. So this is increasingly becoming a popular diversification strategy for high net worth individuals.
Yeah, the first thing for me is like what is an asset as I think we used it back. So some tokens have kind of tendency and trading history basically. So Bitcoin and Ethereum, then it comes a question of like at what proportion you would like to have. Then is again like the speculative part. Yes, there's a lot of institutional money, for example, going in Solana. So Solana is looking promising. So maybe on the basis of rationality for which I'm getting into Ethereum space, should I get to Solana? Should I get into Polygon, the layer 2 solution? What if ETH2 comes in, Shanghai 4 comes in? What's the impact on Polygon adoption? Will it stop? So based on all these considerations and decisions, then I can keep diversifying, moving back money back and forth between these coins. And of course, as somebody said, like 20,000 of them, then there will be some penny stock considerations. There's like friends and families issuing their own coins. As long as they're public blockchain, why not? I will be keen to look at them. But then coming back to least risk, if that is my option, or a kind of like a growth portfolio, again, there's a whole gamut of things to play there.
Yeah, maybe if I might add, beyond the liquid market, there is the real startup market. I mean, the token VC fund we currently launched. I mean, this is precisely looking into companies that issue tokens and not traditional equity as a new form, basically, of organizing themselves and also, let's say, accessing the capital market. Yeah, I think we will see much more innovation there, and this is certainly huge. But the risk is certainly also high, definitely, like in the startup field.
Thank you. So as ChainBLX, we did also some research on this before we accepted crypto funds in our company under our umbrella, and our decision was based on one main point. We didn't see any correlation between crypto assets and the stock market or any other commodities at the moment of the evaluation. This means that because they're moving totally independent, investment diversification in this asset should be done. Also, we believe that the normal measurement, which we use better to just reduce volatility, was good in 1954 as it was invented, but is not anymore appropriated, because at this time you just wanted to have the market risk, and you didn't look at the firm-specific risk. Today, it's the alpha, and going back to the fundamentals of every part becomes more and more important. Like, I think I hear the same agreement there with Oliver, as he said, you have to look more on the logic, what the cryptocurrencies are doing, but also by every other firm. Because in the old models, we didn't predict for events which couldn't be foreseen. For example, foreseen events like in ERGs or something like this. Suddenly, it is important for investors, and it is important that a company behaves in an ethical way or behaves in a certain way. And all the other changes in the economy since 1954 was basically putting this more that we have to go back to the fundamentals. And therefore, we think it should be diversified also in crypto. We had a quick estimate done, a survey yesterday night, and there we asked the general public, what portion of your crypto should be, investment portfolios should be held in crypto? We had 65% of the public saying no crypto at all. We had 12% to say that 5% or less should be holding crypto. We had 9.2% saying that 10% or less should be holding crypto. And we had 14.5% of the general population saying that more than 10% should be held in crypto. This was a survey, and we had a response rate from 17,000 people in the United States this night till today, all over 22 and below the age of 60, female and male.
That's actually pretty impressive, because and I assume people who answered with let's say a high rate like 5 or 10 or even more percent allocation to crypto are rather the people with who are better off than the average. Yeah? If really these assets would flow into that market, we would see an explosion, let's say, of the crypto market value, definitely. So there's, let's say, potential here if they really make that happen. The second aspect which came to my mind when you were mentioning the correlation between crypto and other asset classes, I think what I have perceived in recent months with the entry of more institutional investors, yeah, and that's also a difference to the internet development. Yeah, there you had basically first institutionals investing and then retail. Here you have first retail and then institutionals coming to the game. Yeah. With more institutionals entering the space, we see, or I perceive, a higher correlation between crypto markets and other asset classes, and especially a high correlation with the liquidity that is in the market. We've seen that once the Fed basically reduced liquidity, the crypto market and crypto assets were more or less perceived by many investors as risk assets. So it was a flight into so-called safe havens. Yeah. However safe they are remains to be seen. So it will be interesting to see whether we, over time, will see a real decoupling of crypto assets and traditional markets. I'm not 100% sure yet. I would like to see it, but.
So I think that poses an interesting question, though, of what decoupling really is. So, for example, something like the real estate market versus the stock market, they're arguably not 100% uncorrelated, but the stock market comparatively tends to be a leading indicator, and the real estate market tends to be a lagging indicator. So they do operate on different market cycles, essentially. And there is an argument to be made for blockchain and crypto as being essentially a tip of the spear indicator, in a sense that because it's such an emerging asset and because it's so liquid, and all of these attributes, that it can react very, very quickly. And so in that regard, operating on a different timeline, even if it is, based on the market, is in and of itself potentially valuable for overall diversification.
Yeah, maybe one aspect I would like to add here is that with the recent rate hikes, I had a look at the real estate market because you just mentioned it in Europe, yeah. And this came basically from December to January, February this year to a complete stop, yeah. There is zero applications for credit to invest into real estate anymore, yeah. prices are more or less in all locations in free fall. Yeah, in free fall. It's more or less impossible to sell real estate today because people cannot get credit anymore. Yeah, they cannot pay the loans.
Yeah, and this is also right now discussed in the Congress here. There is a new bill because banks stopped lending money, and for this, it's seen by both parties in the United States, and this is also interesting, which we are just following, nothing to do with crypto right now, but that they are starting to deregulate a little bit and then upping up the limit which you can raise money in alternative sources through Reg A and so on, which is like we see addressing non-accredited investors and so on, just because of the mere fact that it was noticed even by the Congress that the banks stopped lending money for small firms and construction businesses and so on, and that this is a threat to the economy. I see we are like already next to 2 hours, so I jump to the last question, and I would like to know if this surprised you. We asked around and we surveyed basically wealthy individuals which uses private bankers, investment consultants, and one second, am I still on? Yeah, I'm still on. Sorry, my computer just went blank. I was unsure if I'm still live. So if their investment banker or consultant was advising them to take crypto in, so the result was that their investment banker or the investment consultant, 9.6% advised them to take crypto in their investment strategy into consideration. 88.3% didn't advise them to take crypto in. And the rest, minority, I don't have this data here right now, we have to calculate together, only a small fraction, they were advising to go to a specialist in crypto. So what we see is that we have a market demand from 30% of investors who wanted to have cryptos in the portfolio, but only around 9.6, also 10% of investment like private bankers in Zurich and in America will advise their clients to invest in crypto. What do you think about this? Does it surprise you? What do you think is the causes for this? And these are comments.
Oh, I can jump in here. I think it doesn't really surprise me because I think it's a generational topic as well. Advisors in that space tend to be conservative. Yeah, it's about protecting wealth. Yeah, so I think with that, and they are probably also not too open, let's say, in this digital world, and it's also a very small asset class. It's a baby asset class. I mean, when you look at it from a global perspective, top down, we are talking about $1 trillion or so, between 1 and 2, 3 trillion size, versus I think real estate is something like 200 trillion, roughly in my mind, 200 trillion, 200 trillion or so, or maybe 150 trillion equity. And 150, 200 trillion, no, 250 trillion bonds. Yeah. So if you look at it from this perspective, it's clear that they are not too bullish, let's say, and they are beginning to look into that space because you have over the last 10 years outsized returns. So it has been proven by the big banks like JP Morgan and others doing studies there that if you add, let's say, 1 or 2% crypto exposure, you can significantly increase your returns with a minor increase in risk, more or less.
Another relevant point is that in many countries, as well as in many institutions, advisors have been historically banned from advising clients to purchase crypto, and or have been banned from personally owning any crypto themselves. So this, in many ways, can contribute to that effect, where in the first case, certainly, if there's a legal incentive or disincentive around making that advice, then that's certainly going to be a detractor. And then if banned from personally owning any, even if they are allowed to provide advice on whether or not to own, is going to encourage is going to encourage a insufficient understanding of the asset, essentially, if not allowed to actually experiment with the asset itself. So those are some relevant factors to be considering around that as well.
Yeah, and just to add a little point here, like, yes, wherever it's not allowed to advise, and you also had the advisors for MicroStrategy, just naming one. That yes, why? Because they are good in crypto, and crypto is on the rise. I'm talking about the time when 41 to 66,000 rise happened.
Yeah, and maybe one additional aspect. I mean, it's also clear that in this industry we have still a developing layer of custody providers, for instance, and this is especially important for institutional investors. Yeah, they simply cannot invest in those vehicles. We've seen in the US, for instance, this whole discussion here around grayscale and ETFs and stuff like that, converting those instruments basically in accessible financial instruments. That's a regulatory topic. That's why we have seen companies, for instance, like MicroStrategy, which is essentially an investment in Bitcoin that you can do and work around basically your way when you want to get exposure here. But once this whole thing is emerging, and in Europe, for instance, we have with a new MiCA regulation certainly move into the right direction. Yeah, we will see more adoption.
On a related positive or optimistic note, just looking through the data, the capitalization of cryptocurrency and digital asset investment funds has been roughly doubling over the last several years, for roughly around the last 4 years or more. And so if that trend even comes close to continuing, then we're definitely seeing very healthy adoption on the institutional level, given that most in cryptocurrency investment funds, as with funds in general, tend to cater more towards high net worth individuals and institutional audiences.
Okay, so thank you everyone for participating. And I would like to give everyone one last chance to add to the subject whatever we missed in this discussion. It was really interesting. I thank you all. And last chance, let's start this time from left to right. And Amandeep, you start, then David, and then Oliver.
I will still speak like an advocate for adoption, that if you have been sitting on the sideline, whether it should be considered as an asset, probably this is the time. Probably this is the time to get in. Probably this is the time to evaluate. Time to build a new solution if you have a technology team. maybe there's no time better than this right now.
Yeah, so thinking through basically the interaction of market cycles and adoption trajectory, essentially building off of what Amandeep mentioned, really many would argue that we're in a similar position in the market right now to what we were in 2019 before a major bull run that happened in 2020, 21, et cetera. So in that regard, there does seem to be, according to many experts, some strong potential for getting in at this stage in the market. Beyond that, just related to the adoption overall, that really historically so far during those more bear markets in the blockchain industry has been a time for real building out of use cases. And I would just say that I'm really excited for a lot of these use cases, ranging from bigger, better, faster, stronger payment systems, smart contracts, decentralized banking, gaming, identity, supply chain management, the works. And so really I'm excited to see the interaction between what appears to many to be a very positive trajectory in the market cycle overall, the interaction with that and the adoption curve that the stage of the adoption curve that we're at.
Yeah, I agree to all that has been said. Add that to me, it's clear that right now we see the solutions in development that will materialize in real disruptive innovation, building on blockchain technology, and it will be realized by companies which manage to establish a token economy on top of decentralized ledger technology. And in that respect, it's certainly would be a very wise decision to enter that market now.
Thank you very much, everyone. And thank you for our European panelists. They have really late at night now, 10 o'clock, and taking the time out during the week and staying up just to hold a conference. I thank you very much. Thank you very much, David, which is in New York. So he has, again, a little bit of daytime left to do some work. So I thank everyone and appreciate to discuss this topic at Digital Davos 2023. Thank you very much.
Thank you, Carl, for having me, and thanks to my fellow panelists as well.
Likewise.